Hey everyone, me Kevin here. Over the past few days, Nick T from the Wall Street Journal, also known as the Federal Reserve's mouthpiece or leaker, has tweeted a few different articles that I thought would be worth going through. In fact, he's tweeted quite a few. He's tweeted a Bloomberg piece here, we've got a Wall Street Journal piece, we've got a Kansas City Fed piece, and what I thought is, why not just give a very quick consolidation of what the goodies are within this? So the first argument that they make is in the Wall Street Journal Central Bank's website, which usually you have to pay a lot of money to access this. It's like $2,000 a year, but for some reason the link he shared was a freemium link. So let's get into it. I used to be subscribed to them, but I didn't think it was worth it. Sorry, WSJ. Anyway, consumers expect inflation to stay high over the coming months, but decline in the years ahead. And so this piece really nails on inflation expectations. And what I think is so great about this is I think there's a chance you've got Nick T here, sort of on behalf of the Fed, going, hey, you know, as long as expectations remain like this and people actually think inflation is going to continue to fall, then we're on the right trajectory and maybe there's a limit to how high ultimately we need to go. It's just a matter of how long are we going to stay here. But what's good also is to see that consumers now expect inflation to be 4.1% a year from now, and that is the lowest reading that we've had in the last 2 years, which is great. By the way, happy 4th of July. My marketing guy would be very upset, by the way, if I didn't mention that we have a flash sale on the website. They're kind of a secret. There's a little flash sale. This is the only place I'm mentioning it. But flash sale on the website for the programs on Building Your Wealth. That's the AI course, the How to Make More Money 1, Zero to Millionaire Real Estate Investing, Property Management, Real Estate Agent, the YouTube course, the Stocks and Psychology of Money, you name it. Amazing programs. They all come with course member live streams, phenomenal content. Check them out, link down below. Okay, so then more important for the Fed, consumers expect inflation to ease to 3% in 3 years and 2.7% in 5 years. Now, this ends up being a very important number, this 3% number, and I'll show you where that comes up in the Kansas City piece in just a moment, but keep your eyes on this, which ultimately, that's going to be good, but take a look at this. This is probably the first time I've actually seen mention of this ever since I've been pounding on the table for the last 3 years talking about FATE, flexible average inflation targeting, which is the Fed's policy to pay attention to average inflation over time. This is the first time I've seen it used, like in the past couple of years here, and it's from a piece Nick T shouted out. And it says here that inflation expectation would average out to 2.8%. And it compares that 3% 3-year inflation expectation to the average of 2.8% we had in the 5 years before the pandemic. Now that's crazy. I didn't realize this, but in the 5 years before the pandemic, inflation was always sitting around 1.7, 1.8%, something like that. But expectations for inflation 3 years out were actually 2.8%. Now that's remarkable. I don't know that any of us have really thought about that before. If inflation was constantly sitting around 1.7%, why would consumer expectations be 2.8%? That seems a little bizarre, but I guess that's what it was. Well, what's crazy is if we're trying to get to 2% and expectations are roughly about 3%, then we're pretty dang close to what we had before the pandemic in terms of expectations. Now, why do expectations matter? Well, it says here, the Fed thinks the psychology of people thinking inflation is going to be kind of nearly what the levels were before 2019 is a sign that people might not rush to spend money in anticipation of rising prices, inducing inflation. In other words, you can take your time to buy stuff because prices will be relatively stable, and that prevents the supply distortions and the unstable prices problem the Fed is trying to fight. Long and short, this, out of the 3 or 4 pieces we're going to look at, this one right here, really incredible. Not only did it reiterate that we're at the lowest inflation expectations in 2 years, but this idea of inflation expectations being pretty dang close to their pre-COVID levels in terms of an average, remarkable. Had no idea, which is great. This is pretty neat as well because it shows you those inflation expectations. You can see the 1 year ahead plummeting, and then of course you have the 3 and 5 year right here, which is relatively stable. What else did Nick T tweet? Well, he tweeted about used cars and new car prices. And here's something that I thought was fascinating as well. It wasn't just that the pace of new car sales rose to 15.6 million in June. That's way up from the pace of 13 million a year ago, which is great. Still below the usual that we see around 17 mil, or at least saw before the pandemic. But take a look at this. They give this example over here of basically somebody who comes with a 3-year lease that's up on a Ram truck, like a pickup truck. So he's got a 3-year lease. The 3-year lease is up. Goes in and he's like, yo, my lease payment is $394 a month. I need a new truck. I need to renew my lease. And the dealer's like, well, great news. You're now going to be at $687 for the same damn car. And at that point, people are like, what the F? This sucks. $300 more a month for the same freaking car. So what they do is, as the article says, they don't just go buy a new car or release a new car. Instead, they go into the used car market, which the used car market is really important because it could be a leading indicator for what's going on with CPI, Consumer Price Index inflation. And see, Goldman just released a piece saying that used car auction prices declined another 3.3% to 27% above pre-pandemic levels in the first half of June. In English, we're seeing this continued disinflation on used car auction prices. And that takes a few months to really show up in used car prices in CPI. But now for the July CPI report that's coming out on July 12th, which is in 8 days, they actually expect used car prices to drop 1.2%. And this tends to be a hot segment, both new and used cars, that could drive up inflation. We don't want that. We want to see that inflation come down. And since we're on the Goldman piece here, I have to say, the fact that Goldman is titling this Core Disinflation Picks Up Speed, absolutely phenomenal. Usually these folks are bearish on inflation, and they're actually lowering their core inflation forecast for both December 23 and December 24 to 3.7 and 3.4% respectively. This is fantastic. And remember, Howie doesn't actually think we're going to be back at 2% inflation until 2025, which is great because that means they're willing to be patient, which is something we've been looking for. The idea of like, okay, how patient is Jerome Powell willing to be? And it was on the panel with Sarah Eisen where he revealed, I don't think we're going back to 2% until 2025. That to some extent is a level of patience. And I think that's why the market is now mostly pricing in just one more hike and not two. Remember, there was a lot of talk that we might see 2 rate hikes. What instead we have is now an 88% chance of 1 in July, and then a 71% chance, which has actually been rising over the last week. That is, the odds of us actually sticking to just one more rate hike between July and September has been rising. It's up at 71%. So really, it's probably like, if we're going to get more hikes, with the data we're getting, it's one more and done. Now, it's not just the used car piece, though, that he tweeted out and the expectations piece. He also tweeted out this piece from the Kansas Fed. And the most important part here is really just this argument that the Fed's level of policy hasn't gone to restrictive since the first quarter of 2023, which means they really just became restrictive, and that means it's probably going to take some time for that to really impact markets. Now remember, why does that restrictive level matter and that 3% I told you to remember earlier? Remember? Okay, well, it matters because of the formula. Remember, inflation expectations 3 years out. What was it before the pandemic? Well, before the pandemic, it was about 3%. So you add a 3% level inflation expectations 3 years out. Then you have the restrictive or the accommodative level, and that depends on what inflation is doing. So before the pandemic, inflation was running below 2%. So they were actually accommodative. Now they have to be restrictive, and we believe that restrictive level is somewhere around 2% restrictive where they have to be to get inflation down. What does that add up to? It adds up to 5%. If the Fed thinks that restrictive level needs to go up to, say, 2.25, guess what? We go to 5.25, that's where we get an extra rate hike. Look how fun this is, though. Fun. It's math. Anyway, if you go to accommodative, like we had before the pandemic, maybe you're negative 1% here. So, pop quiz. What's the FOMC rate? If the expectation is, say, 2.8%, which was the prior, right? 2.8%. and then you have an accommodative level of, you know what, let's call it 0.8%. What is the Fed FOMC rate going to be? 2%, which is basically where we were before the pandemic. So this shows you how the Fed can accommodate with that 3-year inflation expectation of around 2.8%. And it's crazy to me that 2.8% 3-year inflation expectation doesn't actually have to be 2% to get 2% inflation. That's crazy. Okay, crazy. So now we put these pieces of the puzzle together. What do we have? Well, bottom line, great news. More vehicle disinflation. The analysts are finally rolling over, indicating that core inflation is disinflating. It's going to take time. The Fed's willing to be patient. We're only pricing in one more 25 BP hike. Kevin's got a secret flash sale for July 4th. Link down below. It's a pretty good one. And if you want to bundle up, email us at staff@meetkevin.com. And you know what? I just wish you a happy 4th. This is all like good news. Again, I'm looking for bad and bearish news. I'm not trying to be a perma bull. You know this. I have concerns about the summer travel spending really pushing up core temporarily. That has not changed. I still have those concerns. I'm not sure that it's worth trading on those concerns. That's the part, that's the really hard part, is evaluating like, okay, we might see a pop in core, but what if that's already being expected or priced into seasonal adjustments? I don't know. So we'll see. But anyway, appreciate you being here, and we'll see y'all soon. Thanks so much. Goodbye. Have a great 4th. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by